I start right now. 1, 2, 3, top of the hour, guys. Nice to see you. I know most of you, I think. I'm Teresa Morrison. Hang on, I'm going to get rid of that because I'll step on it. I was just telling a story when I met Michael Tidwell 3 years ago now, I think, at BTC++, which is a developer conference in Austin run by Nifty Nye. And Tidwell looked at me and he said, okay, so what do you do? And I said, ooh, I don't know. And he looked me dead in the eye and he said, well, you better figure it out fast. So 3 years later, I finally figured it out. About a year and a half ago, I started working with a company called BlockSpaces. That's Gabe Higgins and Rosa Shore started that back in 2017. And I got involved specifically because of the Lightning Finance that we're about to get into and address. My background is in traditional finance. I go back to the origin story of interest rate swaps and derivatives before there were such things as financial derivatives. I actually was involved in the first globally syndicated interest rate swap, and then I promptly moved from the United States to Johannesburg. And the CEO of the startup bank that I worked for, Investec Merchant Bank, looked at me and he said, well, you did it there, you can do it here, except that the country didn't have a market. So I was put forward at the age of 25 to build the market. And I did, along with a lot of help and some really good players. Fast forward many careers later, and we're able to do very similar things again. So I get to call on some really obscure knowledge and bring it forward to see how it can fit into the world of Bitcoin. Personally, I've been doing a rabbit hole since about 2017. Not nearly as knowledgeable as I know many of you are. But let's see how we can bring this forward. It's not about me. It's about what do we mean by Lightning Finance? And we're taking the concept of building a block space forward market. I'm not sure how many of you, this is like a new software and I don't know how to make it click forward.
Yeah. Yeah.
That one. How about that? Very simple. If any of you have been here before or you've listened to podcasts with Bob Burnett of Barefoot Mining, you will have heard the story of Blockspace and the pending, although not imminent at the moment, potential for Blockspace scarcity and the value that Blockspace will have. So we take this concept and we say, how are we going to build a forward market? Why do we need to build a forward market? And then the foundations of a forward market actually require a collateral contract structure. How do we do that natively on Bitcoin without it being at the UTXO level because you don't have the volume of activity that you need for a forward market to be liquid? So we'll be looking at some of these topics. We're going to breeze through block space because hopefully you all have kind of looked at that. We all know how blocks get filled, right? You bid, the mempool kind of sorts it. The miners decide based on their policy, which they're going to maximize their fees. And then those blocks, those transactions that fit the policy and the monetary reward end up being included in the block. What we also know is that the blocks have limited space. And to the extent that there will be technological advancements of condensing data, it still has a limited space. It's currently about 4 megabytes. It's measured in weight units, but it's roughly 4 megabytes. On an annual basis, that gives you around about 210 gigabytes. To put that in perspective, your iPhone has 256. And that's 210 gigabytes per year. That's a lot of data, but not as much data as the trillions and trillions and trillions of data that actually gets settled in traditional finance. So at some point, as we get more adoption in Bitcoin and more movement and payments in Bitcoin, we will begin to run into this wall. And it kind of looks like this. This part is the bear market up until sort of mid-23, end of 23. And then we get into last year where we had a little bit more activity, a bit more of a bull market. And then you can see right at the end, the last couple of days, we've had a few blocks that haven't been filled properly. There's been a sort of price dropping, and, the public securities market, for those of you who actually pay attention, are down significantly. I think today they're down about 6%. Gold is down about 3%. Bitcoin today is up 3%. So Bloomberg actually had a little statement on it that said, Bitcoin seems to be breaking its correlation with risk on assets. I was like, they finally figured that one out. So, all right. So just a quick recap. We've got fees at the base that actually makes Bitcoin work. We have limited capacity. And then we have block space, which we think is going to be scarce. And we actually think it's going to be a premium resource. But it's more than just high fees that are going to cause this, right? We're looking at a situation where at the moment, so we don't have a forward market for block space. We have a futures market for the price of Bitcoin, but we don't have a forward market. The current market is a spot market. So you can put your transactions up for immediate inclusion, right? You have real-time bidding. If you really, really need that transaction in, you have to RBF or do another payment accelerating mechanism. You are subject to price volatility. You can monitor it as much as you'd like. You can kind of plan for it. You can pick low vol times. But at the end of the day, you're subject to that immediate spot market price volatility. And you lack an element of uncertainty or lack certainty. You have elements of uncertainty of whether your transaction's going to get into the blockchain within the time frame that you would like it. And by that, we can go back to runes, right? You can, there were times, that's way back on the slide. There were times in the last year where there were a lot of transactions. We had 2 weeks worth of transactions in the mempool, right? That doesn't work if you're running a business. It's a long time to wait to pay for that coffee. So in a forward market, what we're really doing is we're setting up a structure so that we can plan. We can plan forward. The concept behind a forward market, it originates essentially in the agricultural market. I have gray hair. When I went to college, there were no such things as financial derivatives. So in my studies in econometrics, I went through and I'm like, well, I want to understand futures and options. And the head of the department looked at me and said, well, you're going to have to take agriculture class. I'm like, I don't want agriculture. It was the only place that I could learn about futures and options. But a good foundation because the principles of it actually stay. And then from that, I actually was able to get accepted into as an undergraduate into a PhD class on game theory. So I feel right at home when I met everybody from Bitcoin. I'm like, whoa, right? So block space forwards, it's risk management, it's hedging. It creates an element of price stability, doesn't change volatility. It just creates an area of price stability. And the focus that we're looking at is creating a transparent market, right? So an open market. At the moment, you can do accelerators, you've got slipstream, you've got out-of-band transactions, and those all work. They will all continue to be available, but they're not open, they're not transparent, and that means that they're not really available to smaller transactors. So essentially, the foundations of a forward market is that it gives, you have primaries, right? So you have to have hedgers. You have to have a dual-sided market where you have hedgers, natural hedgers. You can't force them. You also cannot have a forward market that is a one-sided market. So on this, in a block space, to create a market, the dual-sided market, you have users, you have to have enough users with enough reasons to want to buy block space forward. And then on the other side, it is block space, you have miners, right? So we know that those are the natural hedgers. If you think about it in the world of airlines, we have oil producers and then we have airlines. They need to hedge their costs. The oil producers need to understand their revenue. In a Bitcoin world, we have users being financial institutions who need, or corporations, and I'll give some examples in a minute, who need certainty of block space inclusion, and they're willing to pay for it. And you have miners who want an element of certainty to run their operations. Doesn't mean that everybody runs their whole operations in a forward market, but they will take a percentage of the business to minimize that operational risk. So on the user side, just to give some ideas, like put it in context, because people are like, well, you can just pay for it. If you're a corporation, right? So we now have a lot of corporations who are beginning to add Bitcoin to their treasuries. They're being hodlers. They will at some point, hopefully, start paying dividends in Bitcoin. They will have Bitcoin bonds that will pay interest in Bitcoin. Like at the moment, it's still in fiat, but that will change. When they have the ability to do that, they have to issue sometimes 2-3 years. Well, on a bond, many, many years in advance. But on dividends, at least a year in advance, minimum, what your dividend dates are going to be. And you have to make those dividends, right? You can't just say, oh, well, was busy in the mempool and we didn't get it to you on the day. So there are reasons why the users will come once we have product available. Once this is available, the second part of the market is the secondary trading. You need the traders, you need the arbitrage, you need the volume that they create because they create price discovery. That is how mountains and mountains of information are incorporated globally into a price of what block space costs. And then that is transmitted through their trading and pricing mechanisms so that we begin to know what the price actually is for block space. And that, of course, then creates liquidity. You have a lot of players in the market. There's more money that comes in, and then that creates more liquidity in a broader market. Oh, dear. Okay, hang on. Where'd it go? See, I didn't do this. All right, guys, hang on. Let's see if I can do this. Oh, it's gone. It's just gone. Huh. Right on cue. Did you find it? Okay, so wow. Okay, it's gone. Let me see if I can find it. This is what happens when you use something on the internet. I should have downloaded it. I will
do it. Continue.
Yeah. Okay. So I'm just going to keep talking, right? The slides are the slides. They are what they are. What this leads us into is what a forward contract is. I promise this is like the longest part. And then we get to the fun part and you can ask me all the dev questions like, how did you guys do that? So the way a forward contract works is you initiate a contract. You then have to fund the contract, which is put up post collateral. So when you initiate a contract, there's no payment. You then have to post collateral. So we need a place to put the collateral. You then have to monitor that collateral value and adjust it between the counterparties. This is actually a really big problem in TradFi. It takes them hours and hours and hours overnight to figure out how to do that. Once you then have to settle the contract and then deliver the collateral back to the appropriate party. So are we getting there? Oh, awesome. Yeah, hey. Okay, we're going to do, okay, this is good. Okay, right. So this is where, right, contract initiation, there we go. Oh, man. Okay. So then so what that means is that we have a contract that has all of these components that are like ideal for Bitcoin. So, but in order for them to work on Bitcoin, we need a Bitcoin native.
You go full screen, you get rid of the bar, that's when it disappears.
We can just keep the bar, right? You guys, I did this on Gamma app. It's still hard to use, but I think maybe one day it'll get better. So the whole point is that we were like, in order to put this contract up, right? Like what TradFi's doing at the moment is they're doing something very similar to this. They're running it in DeFi, but they're taking Bitcoin, they're wrapping it over in Ethereum so that they can run these smart contracts, and then they're unwrapping it. And it's like all these attack vectors. It's like, why? We don't need that. We can do that. Bitcoin was built for this. We just have to figure it out. And so we have a programmable smart contract. How do we do that on Bitcoin? And that's where we addressed it with Lightning. It's like, how do we do this in Lightning? So principles behind the design has to adhere to the Bitcoin ethos, has to be transparent, has to be private, has to be non-custodial, peer-to-peer, and it has to be fully Bitcoin native. And sorry, I couldn't get this on the Gamma app, so you guys are getting like pictures of some pitch deck. We built something that we're calling auto-reconciled collateralized contracts. It works in a whole variety of different situations. It could be lending. You could just be a Bitcoin hodler. Although I do have to say that if you've got a long-term loan and you're wanting to do a mortgage, just leave it in your UTXO and do it the traditional way at Unchained or a variety of places. If you want to get into trading and high velocity, high volume, this is more along the lines to go. So the focus really is more for that hedge fund, institutional trader, or a trader who does a lot of high volume. Sure. We are. So by the way, we've developed two different technologies. The foundation technology we're going to be open sourcing. The guys are busy building out the SDK and the documents for that. We're hoping that will be kind of available in May. So if anybody's going to BTC++ in Austin, Nifty NY, that's the mempool edition, which is on May 7th to 9th, I believe. We're not launching it there, but we'll have a bunch of devs there, and we'll kind of be sort of soft talking to the community to let them know where to find it. So this was kind of how we approached it. We want it to be Bitcoin, Lightning, and then we have this kernel on the top that we work with, kind of the basic features of creating some form of secure enclave, making sure that we have redundancy, making sure that people don't lose their money, all those good sorts of things. And essentially what ends up happening is you have the Lightning application, which is using the protocol. It is not using the Lightning network. And it allows for these high volume contracts at the top. In this diagram, we've got institutions, but it could be peer-to-peer. And once they've done the contract, the initiation of the contract starts at the UTXO level. The completion of the contract ends at the UTXO level. So we do have payments going in and out. And the adjustment of the collateral value in the contract is done up at the Lightning level so that we can have very precise payments at a high degree of frequency with a significant volume of contracts being run at a time so that we can match the type of volume that traditional finance requires. The reason we're doing this is not to actually solve it for, actually we are solving it for traditional finance, because if we don't, they're going to find another way to do it. And we really want them to use it and use Bitcoin properly and not a half-baked version. Yeah.
You're right. You said you're using the Lightning protocol, but not the Lightning.
Correct. Yeah.
Right.
I suppose you could call it that. Yes, it is very private. Right. It is very private, but it is transparent to the counterparties. And the counterparties do not need to know each other. So it is peer-to-peer. But it doesn't have the liquidity constraints that the network has because the payments aren't floating all around the network. The payment for the collateral adjustment is singularly within the contract. And then the posting of the collateral and the payment of the fiat are singularly in the contract. We, by the way, don't run the contract. That's something that you guys have to do. I mean, come up with the contract. We're not a lender. We're just technology, what we call middleware. Okay, this isn't working anymore. How do I do this? Okay. Nope. Okay, just a sec, guys. There we go. So that's where we do Lightning Protocol. There's no side chains. We're not doing any wrapping. It's not kind of a quasi side chain. It's full on Lightning itself. The off-chain transactions are between those secure private counterparty links, and these are peer-to-peer channels. So when we do this, we go back to where we originally lost the slides, right? We initiate a contract. So once you find your counterparty, however you find them, wherever you find them, you actually want to enter into a contract with them. You will have, there will be platforms. So part of an infrastructure, which we'll get to in a bit, probably should have moved it forward. If you were to go to a lender and a lender had the software as part of their tech stack, they would have the loan contract with the basic terms. The contract itself would then be input between the lender and the borrower. They would be agreed back and forth on either side. And then the contract would start. The terms that are input are automated. It happens, right? It's, again, this is all non-custodial. There's no centralized, we can't touch it. It goes according to the terms. So you want to make sure that when you initiate a contract, you're initiating the terms that you're happy with. It'll manage the collateral throughout the process. It will then settle and move the funds back to the counterparty that requires the appropriate level of what's going backwards and forwards. So in terms of building a block space forward market, there are a couple of things you need. One of the first ones is you need a settlement layer, and that's what we have, right? The next thing we need is market infrastructure. That's where you develop the contracts and the trading platforms. That is not something we do, but there are plenty of organizations out there who specialize in contracts and in lending or in providing trading services. And then there are trading platforms. There are centralized trading platforms, there are decentralized trading platforms, and there are peer-to-peer ways of finding each other. Block space is very interesting because it does actually require connection into the miner. So there are some additional complexities with that. And then the other component when you're doing a block space forward is that I'll get there. Don't worry. I was going in two different directions at once and my brain just went, that's it, done.
Space.
This is for block space on the blockchain. Exactly. The Bitcoin blockchain. So instead of buying at spot, which is what you do every time you want to make a payment into a UTXO, right? You're buying at spot. This is buying it forward. So when you buy it forward, you need to be able to buy it in the first place. So you have to figure out who to buy it from. So the complexity of the challenge is, this is what I was getting to, is that for it to be truly peer-to-peer, right, it's really easy to solve for in a centralized way where we've got an exchange. It is very difficult to solve when it's peer-to-peer because of the rails, the bookends of regulations. So to design a market place where you can find each other in a truly peer-to-peer environment that has privacy is A very, very interesting challenge. Actually, really super interesting. And then you have to get that block space that you bought from from a miner you don't know. Miner has to find it, right? So there's a lot that goes into this. It's not just the financial side. So literally at this point, we've solved the settlement layer to be on Bitcoin. We've solved the volume velocity requirements that are needed for a forward derivative market. We now need to address some of the market infrastructure with other strategic partners. Yeah. Sorry? Uh-huh. What?
Okay.
No. No. You're at this point, eventually I think you will be able to do that.
Like that's
right?
what I'll live with it off there.
You have no idea. That's why I say there are some challenges to being able to bring this specifically to market.
It is the right to put it for just a lot state.
At this point is just the block space, right? So bear in mind, we built the settlement layer. The infrastructure, how the mining pool is going to work, how it goes from a place where a miner can find it and then make itself get it into the mempool and get found, right? Because we're looking for transparency. We're looking for it to be truly Bitcoin ethos, is not easy. Those are challenges that are still being addressed. So I'm not going to be able to answer any of those questions. I can tell you that I do firmly believe that at some future date, not any time in the near future, but at a future date, you will be able to pick a block and be able to put it in. But that's technology many, many years from now. Yeah, and a lot of smart people.
Oh, I mean, all of that fell one. Multiple or anytime.
To get. Yeah. I think when some of the market mechanisms take shape, that you'll see the direction. Yeah, you'll get a range. Yeah.
They will wait.
It'll be very, very difficult for that. But that's why I say it'll be years before that happens. And the reason I think it'll happen is because that's a really cool problem to solve. That's usually how things get solved, right? It's like, how do we do that? Like, if I can do that within a range, how can I do it for a single one, right? Somebody will take up that challenge at some point, but that's not really how the market or a marketplace necessarily needs to work. But I do think it will be taken up as a pretty interesting challenge. Okay, thank you. Sorry, I think there might be, yeah, whatever.